Hi guys, welcome back to Bulls and Bears Market YouTube channel. And in this video, we're going to be looking at the forex market and the stock market. We're going to be deciding on which one is riskier. Generally, people believe that the forex market is riskier than the stock market. It is believed that you can easily lose money trading the forex market than the stock market. But they forget that the stock market is equally very risky. Equities, which is also stocks, is one of the riskiest asset classes. So we are going to be deciding on which one is riskier. Is it the forex market or the stock market? Before we do that, let's look at what is done in both markets. Now, the stock market is a financial market where company shares are listed and traded. So what happens is, if companies want to raise equity capital, they come to the stock market and sell shares to investors. Investors buy these shares and then they can sell it off whenever it is that they want on the stock market. The forex market, on the other hand, is a market where we trade currencies. We trade currencies on the forex market. So it could be online, it could be offline. Offline trading of currencies is what happens in bureau de changes. Whenever you go to a bureau de change to exchange currencies, you have traded forex online. You have traded forex offline. If you approach the malams on the street to exchange to buy dollars, if you're in Nigeria and you approach a malam on the street to buy dollars, you have traded forex. Online trading of forex, on the other hand, is what the banks and other financial institutions do. We also have retail traders who participate in online trading of forex. So the forex market is mainly about trading of currencies. It could be offline and it could be online. Now let's dive deeper into the major difference between the stock market and the forex market. Number one major difference between them is that the stock market operates through an exchange. Now, if you want to buy shares, you have to go to a stock exchange to buy the shares. If you want to buy shares in Nigeria, you have to go to the Nigerian Stock Exchange. If you're buying shares in London, you have to go to the London Stock Exchange. If you're buying shares in New York, you have to go to the New York Stock Exchange. So the exchange more or less controls the operation of the stock market. They decide when the market opens and when the market closes. They give rules and regulations on how the stock market operates. The forex market, on the other hand, is an OTC market. OTC is short for over the counter. So it's a market. An OTC market is a market that is decentralized. It's not controlled by anybody. There are no fixed rules or regulations guiding how trading is done in an OTC market. OTC markets operates through broker-dealer networks. So it's more or less a decentralized market, and that explains why the forex market is a 24-hour market. The forex market does not have a physical location. It's a virtual market. OCT markets are virtual markets. There are no physical locations for OTC markets. So the forex market, like we know, is a 24-hour market, and it can operate 24 hours because it's an OTC market. It's a decentralized market with no physical location. So it opens whenever any financial market. It opens whenever financial markets in the world open, and then it closes when financial markets in the world closes. In Nigerian time, financial markets open on Sunday evening and they close on Friday evenings. Whenever any financial market in the world is open, the forex market is opened. So it operates whenever financial markets are in operation. So the forex market is an OTC market, while the stock market is controlled by exchanges. The next difference between them is that the forex market gives room for the use of leverage, while the stock market does not give you the opportunity to use leverage. Now, what is leverage? Leverage is more or less like a loan. Now, if you want to access the forex market, ordinarily you should have about $100,000. But if you don't have $100,000, brokers have made it easy in such a way that they give you leverage, which is a loan that you can use to access the market with your $50 or $100. You can access the market using leverage. So the stock market does not give you that kind of opportunity, and that kind of makes the stock market a bit more expensive. So in the stock market, there are companies that trade for as high as $2,000 or even more per share. So if I want to invest in such companies, I have to have at least $2,000 to invest in acquire just one share of such companies. While in the forex market, with just $50 or $100, I will have access to trading currencies. So the stock market may be a bit more, and if you look at it in that respect, the stock market may be a bit more expensive. Now, the forex market, the last difference between them is that the forex market is much more volatile than the stock market. The forex market is a bigger market than the stock market. The forex market is the forex market has a volume of about over $5 trillion exchanging as every day. No stock market in the world has that much money in it. That's that much volume of money exchanging hands daily. So the stock market, the forex market, is a bigger market. It's a more liquid market. It has more participants in it, so it's more active, and so it is more volatile. The stock market is not as volatile as the forex market. These are the major differences between the forex market and the stock market. Now let's examine the risk factors in each market. Now, the stock market, number one risk factor is the economy. Now, it is common knowledge that the performance of a country's stock exchange is tied to the performance of the economy. So if the economy is doing well, the stock market will do well. If the economy is not doing well, the stock market won't do well. And it makes sense in that if you look at it, companies are what we trade, company shares are what we trade in the stock market. So if an economy is not doing well, most likely companies in that economy are not doing well. Companies operating in that economy are not doing well. And so it will reflect on the performance of the shares of such companies on the stock exchange. So that is why the stock market reflects the health of any country's economy. Number two risk factor in the stock market is that it's a complex market. If you want to invest in the stock market, you need a certain level of financial knowledge to trade in the stock market. You need to be able to understand financial statements. You need to be able to understand a couple of valuation metrics. Except you have an investment or a financial advisor that is guiding you with your trades. Even at that, you need to have a level of financial knowledge to trade the stock market. Also, the last risk factor I'm going to be talking about is that the stock market requires monitoring. So you need to keep tabs on the performance of the companies you have invested in the stock market. You need to monitor their performance. You need to be able to assess how economic policies will affect the companies you have invested in and how that reflects on the company's shares. If you don't do that, you might lose sight of your investment in the market. So you need to monitor your investments in the stock market. The forex market, the number one risk factor in the forex market is leverage. Yes, we mentioned earlier that leverage gives you access to the market. Now, like any loan, leverage is a loan, and like any loan, too much of it will get you in trouble. So if you use too much leverage, you stand a higher chance of blowing out your account because your losses with leverage, with a high leverage, is higher than when you use a low leverage. If you use a high level of leverage, you lose more money when you make losses in the forex market. And you can't trade the forex market without making losses. So even when you're using the leverage, you have to use it in moderation in order to curb your losses in the market. Another risk factor in the forex market is the non-market factors that influence the forex market. The forex market is vulnerable to a number of non-market factors. I'll give you an example. When 9/11 happened in 2001, when 9/11 happened, it affected the market. Nobody saw it coming. Nobody expected that would happen. Nobody knew that the World Trade Center was going to go up in flames. And so when it happened, it influenced the direction of the market for weeks. So all of those kind of factors, all of those kind of non-market factors affect and dictate the direction of the forex market. A reserve bank head can say something and then it can totally change the direction of the market. A president can just say something. Countries can take decisions that would influence, completely change the direction of the forex market. So the forex market is very, very vulnerable to non-market factors. Also, you have to be very, very careful with brokers. The number of brokers in the forex market that are shady. They control their trading platform from the back end and ensure that they control in such a way that they make sure that you make losses whenever you trade the market. And we know when you make losses in the market, the money goes to the brokers. So they manipulate the platform from the back end. So you want to be very, very careful with the brokers you decide to sign up with. Now, having said all this, which is riskier? Is it the forex market or the stock market? Now, looking at it from the surface level, the forex market looks riskier in the sense that you make short-term decisions and then you profit from market volatility. The stock market, on the other hand, requires you looking at things from a long-term perspective. Now, which of these is riskier? Deciding on which one is riskier boils down to the kind of trader that you are and the kind of risks that best suits your method of trading. Now you need to look at a couple of things before deciding on which market you want to trade. If you're the kind of trader that likes to look at things from a long-term perspective, you're the kind of trader that likes to take long-term positions, you may want to stick with the stock market. Now if you're the kind of trader that likes to profit from short-term market movements, you want to pick your tent with the forex market. So it really boils down to the kind of trader that you have, your trading method, and the kind of risks that best suits your trading method. That's all of those things influence which one will be riskier for you. That one, with all of those things, will help you in deciding which market will be riskier for you to operate in. So you do your research. You know the kind of trader that you are. It involves knowing it involves you knowing yourself. So you need to know the kind of trader that you are, your trading method, and the kind of risk that best suits your trading method. That will help you in deciding which market is riskier for you. I hope that has answered the question of which market is riskier. Thank you so much for watching this video. If you're ready to subscribe to our channel, I don't know what you're waiting for. Please click on the subscribe button. We are big on feedback. Please go into the comment section and let us know what you think about which market is riskier. Thank you so much for watching. We will see you in our next video.